This week we're going to talk about phrases and the trust. Yes, they own practically all the point malls in Singapore. But what's the point of owning all the point malls when your share price is underperformed for almost 2 years and long-suffering shareholders of phrases and the trust? I pity you. In today's video, we are going to talk about the reasons why phrases and the trust have underperformed for the last 2 years. Of course, if you are GCP Global students, this is something that we have warned about, preempted you in our various investment classes. And of course, for those of you who want to know more and to know which are the stocks to preempt, that we will preempt and forewarn you, our next class is here, 12th of February. Do sign up and enjoy the early bird special. This is the chart of phrases and the trust. And this is the chart of the last 2 years. Yes, it's actually since the end of December 2020, right up to currently. All right. So look, the share price basically has fallen from 266 down to as low as 222 recently. That is a woeful 44 cents down in less than 2 years, or 17%. When was the last time phrases and the point trust had such a big mistrust in the share price? Now you have to go back all the way to the global financial crisis in 2008, because phrases and the point trust was listed in 2006, and henceforth it hardly showed a year of severe underperformance as what they have shown in the So in today's video, essentially, we're going to share and also more to tell you the methodology that we at GCP Global uses in helping you to preempt and to forewarn you before stocks go like what FCD has done into a lackadaisical mode. So as a shareholder, you basically have suffered a very high opportunity cost of holding. All right. So now, this is just personal sharing because we are just looking at sharing you the methodology, which is quite similar that we have at GCP Global, where we teach our students for the last 33 years, similar to what Mr. Warren Buffett actually exudes in terms of his value approach. All right, so this is not a stock recommendation or buy or sell. Now, I have a deep relationship with GCP, phrases and trust, because if you look at here, ladies and gentlemen, this is the statistics of the top 20 shareholders of phrases and the trust as of 2019. That is India 2019, and you can see, ladies and gentlemen, that my name is here. I'm the 16th largest shareholder with 1.12 million shares. And you can see, ladies and gentlemen, that if you have read my book, that's actually Making Your Millions in Reits. Anyway, this is the book, okay? Making Your Millions in Reits. I have devoted one particular chapter out of 10 chapters in the book to on phrases and the point trust. When did I buy, when did I sell, so on and so forth. So in our last class, we have actually, as well as in the book, we have mentioned that we sold off practically our holdings of phrases and the point trust when they crossed $3 in January 2020, just before the share price actually fell, down to as low as 160 during the COVID-19 pandemic. As a matter of fact, you notice that we have been a very long-term shareholder of phrases and point trust. Now, this is again also in my book, my annual report ranking, and these are the years in which I've been top 20 shareholders of phrases and the point trust. This is my position of ranking in each of the year. So if you look at phrases and the point trust, let's see that my name appears as 16th largest shareholder, and this is my commensurate amount of shares that I own in phrases and the point trust. So essentially, when I actually sold off my 2.12 million shares at above $3, that's more than $6 million worth in January 2020. Exactly what is it that triggered me to sell? Exactly what is it that I've actually then forewarned my student investors, and how you, as a sagacious investor, is able to decipher, right? So that you will not fall into the rut where a share price underperform and you're just holding the baby. Okay, so as a matter of fact, at GCP Global classes, where we teach, one particular very important metric, and That is actually the return on invested capital. Now, what is return on invested capital, ladies and gentlemen? It is operating income just plus tax rate. Of course, for REITs, there is no tax rate, right? So essentially, you can use the operating income, which is very close to the net income, right? Because the net income is adjusted uh, very closely to the operating income in terms of the differences. It's very minimal, unlike normal companies that actually pay normal corporate tax. For REITs, essentially, as long as you pay more than 90% dividend, you are actually exempted from tax. So the operating income, or some tax will call it the NOPAT, that is net operating profit after tax, as a good numerator. The denominator is normally total debt, long and short term, plus the shareholder equity minus the cash in hand. Now, this metric is very good, ladies and gentlemen, in synthesizing and judging a company, right? Because it actually tells us that the value of a company to a shareholder like you and me can only increase if a management of a company is able to, using the reinvested funds. So now, based on their capital structure, if they are able to generate an ROIC above their WACC, or what we call weighted average cost of capital, then this company is on route for outperformance. Now, essentially, this is something that we hold core and true to our heart, and essentially, it's basically no different than what Warren Buffett actually does, because in his 1992 Berkshire Hathaway shareholder letter, he mentioned this: return on invested capital. He's been thinking a lot about it lately. His investment for Czech business law, just like ours. What are the criteria that he looks for? He looks for revenue growth, exactly as us, what we do in GCP Global, strong operating margins of businesses, payout ratios, free cash flows, and return ratios, similar to what we look for and teach in our various investment classes where we analyze REITs in detail. But there's one metric that could tell me what is really up with the company or the management, or how good, whether it's adding value, or that I could judge the quality by. But remember, be able to judge the quality by, and that is return on invested capital. Yes, ladies and gentlemen, very little has been written about return on invested capital in the REITs market. Read media reports, read analyst report, you read shareholding letter. You notice that very little is focused on REITs, because REITs always, their selling point is that, hey, we need to grow by acquisition. But at what cost, ladies and gentlemen? Right? Because they tell you that by growing the asset base, then they are able to generate value for investors. Is this bullshit or what? Or is it true? Well, ladies and gentlemen, according to return on invested capital, a company can only generate value for investors if the ROIC, or return on invested capital, is a strong number to continue to deliver, and particularly more so if it's only above the own REIT or the own company return weighted average cost of capital. Okay, so this is something that's core that we teach in our class. So do join us on the 12th of February class, our next upcoming class, where we focus a lot on this metric to help you to actually gauge and catch the right REITs to have in portfolio. All right, so now, why do we pay so much attention to ROIC? That's because historically, then that's going back to 1928. There's very strong correlation between the return on invested capital and stock valuations, for the S&P, because you have to understand that ROIC is very good indicator for long term, because short term the market is a voting machine, but in the long term the stock market is a weighing machine, and there's a very strong correlation between the performance in terms of value generation versus ROIC, meaning that if a company generates strong ROIC, then they are then able to deliver strong value to the shareholder. So if a REIT tells you, hey, we need to grow by acquisition, fine, you will say, right? But you have to tell the REIT manager, look, you can only grow if you deliver value to me as a shareholder. Now, how, and to what extent are you able to judge value creation? right? Because value creation in terms of ROIC has very strong outperformance or correlation with stock outperformance. Because if there is no good ROIC, there is no good value. There's no good value, then there is no shareholder value creation, right? So these are figures called from performance, very strong historical data dating back to 1928, right? So we have almost close to 100 years of data to back us. Yes, ladies and gentlemen, at GCP Global classes, we are very academic because we will be teaching for the last 33 years. I myself have actually lectured for many sovereign funds, many central banks, many commercial banks, and many of the top investment funds, hedge funds, index funds in the world, as well as REIT funds. Okay, so let's look at one of the key dynamic, okay, for ROIC. Now, this, ladies and gentlemen, is the Fraser Centerpoint Trust, key numbers for the last 4 years. That's from 2018, 2019, 2020, and 2021. Tells you that they're going on acquisition, and therefore they need to go on acquisition because they want to grow your investment portfolio, and therefore, it's good for you based on scale, cost savings. Is what Fraser Centerpoint Trust did. But why is it that GCP Global want upstream investors? This should be the case, right? That is because when we actually use that important metric, that is the return on invested capital, it does tell us basically what will happen to the company. So let's look at this one, ladies and gentlemen. 019 to 020 to 021. Okay, so as you know, 2018 they did not acquire 40% of the Waterloo yet. Neither did they buy the 4 retail outlets like Century Square, Tampines One, Central Greens, from the PGIM fund as yet. So the net profit then was very nice, 99. Okay, so if you actually work on the capital that is used, that means the capital of equity base, plus the term loans, both the short term and long term, to finance this profit, or to generate this net profit, minus the cash that they have, you'll notice that essentially if you take this divide by the invested capital, which is made up of both the long-term, short-term equity minus the cash, you notice that the assets originally generate a return on invested capital of 3.67%. Then, of course, in 2019, they went into the market, raised multi-billion rights issue and basically institutional placement. So have shareholders benefited? Okay, so let's look at the 2021 numbers, right? So 2021 numbers, yes, the net profit has increased, which is logical because of return on assets. But did the incremental cost hit FCT versus the incremental profit, which is basically what you, the shareholder, sagacious reinvestor, should be looking for? So once again, the return on invested capital actually tells you a story, because this is the new equity which is blossomed. It's almost double, right? Because of the new share issue. So as REIT investors, you notice that yes, there will be some form of dilution, but to what extent? This is an explosion of the equity base by 2 times in 3 years. You decide whether it's actually beneficial to FCT shareholders in the long run. Okay, now you can see that these are the corresponding numbers that will go into working out the ROIC. Now, the ROIC of the return on invested capital now is at 2.8% at the end of 2021, after the multi-billion acquisitions of Waterway Point, 40%, after the multi-billion acquisition of the 5 central retail places or malls from the PGI fund. So you can see, ladies and gentlemen, that the return on invested capital is way below, the number of 3.67% compared to 2018 before they embarked on any acquisitions whatsoever. So did these acquisitions benefit shareholders? You decide. The numbers tell you a story, right? Let's move on. Okay. Now, in fact, ladies and gentlemen, if you are not so math orientated, just do a simple analysis is what we try to simplify for you in our classes. Again, this is the 2018 to 2020, 2021, the last 3-year change, right? After the whole complexion of the REIT has changed, you can see that the interest expense, because of newer loans that's needed to actually finance Waterway Point plus the acquisition of the PGI and portfolio, you notice that interest expense have boom more than 2 times, from 20 million in 2018 to 46 million in 2022. That is a 129% increase, ladies and gentlemen, or 26 million jump. Okay, now management fee, who benefits is the fund manager, right? Or the REIT manager, increased from 15 million to, wow, more than doubling, $33 million, okay, or a 17 million jump, which is actually 112% increase. Okay, the net income, yeah, it did increase, but guess what? It is increasing less than the jump in this cost item. So that's why the net profit has not grown as fast as the jump in expenses. Of course, these are above the line, and the REIT manager will tell you that, yeah, because of these new expenses, the net profit has grown lower. But hey, think long term. Yeah, think long term means your share price probably underperformed as it has underperformed for the last 2 years. Is that correct? Well, you decide. Okay. But anyway, ladies and gentlemen, just for simplicity's sake, I've actually looked at one item below the line, that is acquisition expenses. Now, it is actually very expensive to undertake acquisitions. For example, certain countries like Australia, UK, you have to pay additional taxes, right? And for FCT, you notice that the expenses that they paid, 10 million related to acquisitions in 2019, 2020, 3.8 million, 2021, 5 million. It's a big jump of 25 million compared to the zero in 2018. So you add up all these expenses, ladies and gentlemen, you notice that this number is at 68 million. 68 million is higher than the 66 million that the incremental net profit brings in. So of course, the share price don't move. In fact, the share price has decreased, probably is a reflection of the non-increase in profitability after these big acquisitions that the REIT have undertaken. And mind you, the manager have actually gone on to the roadshow and tell you that all this is beneficial in the long term. It's up to you to believe whether this will be beneficial in the long term. But these are what the numbers have shown is of the latest versus before trial acquisition. Okay, so ladies and gentlemen, as we go into the new year, you notice that we like at GCP Global to tell you, okay, and to actually show to you, to our GCP Global students of 8,000 now internationally. When I say GCP Global students, we're talking about the funds that we teach, the index funds. Many people send the family offices representative to our classes. Now, we've been teaching for 33 years now, teaching people the central bank, the sovereign funds, the commercial banks, hedge funds, the REIT funds, and the income funds. Okay, so what we actually try to share in our classes is to help you to buy and position well into the REIT portfolio, so that this means that they are able to preempt and forewarn you of those REITs before they go into a lackadaisical mode of performance, as what FCT did, as well as to help you to rejuvenate and look at the REITs that you should have in a portfolio for outperformance in 2022. Okay, so do sign up at our GCP Global website, okay, and do try to catch the early bird special over here, right? So also do sign up also for our GCP Global website updates, because every month we give you very good insights in article. In fact, we have an archive. It's been there for the last 33 years, right? So yep, so that's the kind of detailed analysis that we look at GCP Global. So you may ask, going back to FCT, how was it that we were able to warn our students about this potential underperformance? For those who have been attending our classes, you notice that we pour through reports by the firm, we pour through performance numbers, metrics, what the management say, and compare to what they have been able to deliver the actual hardcore numbers. Some of this, can actually have pages running almost close to 1,000 pages, but we still peruse through them and share the view. So for example, if you are able to look through as what we have done so in our GCP global classes, when we went through the AGM of Reits Trust in September 2020, right? Remember we sold out the stock at above 3 at in January 2020. So if you look at the AGM, feel you're not satisfied in September 2020, you could have still sold out of the stock between the 260 to 270 level, which again I did share with students in my classes, right? And essentially, one of the minutes actually minuted, right? What is the growth of FCT after the acquisition, and what did the manager say? The manager say that they're going to grow from economies of skills in the operations. They're going to strengthen their retail platform. Very generic. What does it mean? Savings in interest rate, interest expenses. So as you saw in the previous slide, the interest expenses have shot up from 20 million to about 26 million. So what's that? And to what extent is savings in there? I do not know, right? And increasing the financial flexibility. Now, so the key question, ladies and gentlemen, is that this is what's being said by the manager at the AGM. You, sagacious manager, investor have to answer, have they delivered? If not, when? Okay, of course, you wait long, it may happen, okay, but how long do you need to wait? Of course, in our classes, that's where we go into this in detail for you, okay? And our last slide, ladies and gentlemen, is the fact is that, another key question that came and bothered us at the minutes of the September 2020 AGM, which we shared with all our student investors and warned them about underperformance of FCT prior to this lackadaisical performance, is the fact that one question was asked: are there any asset enhancement initiatives the board like to propose? And what did the board say? The board say that, hey, when they acquired the PGI and portfolio, 3 out of 5 already have undergone asset management initiatives. And this include White Sand, Tiong Bahru Plaza, and Century Square. Wait a minute. If you look at the latest results that they actually dish out, you notice that Century Square actually has been and has become a problematic mall within their portfolio in terms of renewal rentals, in terms of the kind of spaces or bulk spaces that they actually mention, as well as occupancies. So one wonders how come if Century Square have already undergone a major AEI, it is still not being able to generate the kind of flows that is expected. Does it also mean, therefore, that the manager have overpaid for the mall in the acquisition? So, well, you have it, ladies and gentlemen. These are the kind of incisive, in-depth, detailed questions that will guide you for all Reits where we actually go through our classes. So if you like what you see, do subscribe to our channel. Do actually email or us at gcpglobalsg@gmail.com if you actually have recommended a friend, so that you stand a good chance of a giveaway at the end of this month if there are more than 20 people participating in this event. If not, then hope to see you at our classes 12th February, and do look and watch out for our next week's exciting video, as what you should be watching every other week. So have a good week ahead, and in advance, happy Chinese New Year.